Every day, thousands of beginners lose money in the stock market. Not because the market is unfair, but because they're making rookie mistakes that are easily avoidable if you know what you're doing. So in this video, I'll show you the 7 most common mistakes beginners make that could cost you hundreds or even thousands of dollars, and explain how to avoid them with simple strategies that even professionals swear by. Plus, at the end of the video here, I'm going to share one critical mistake that will instantly reduce your returns, and most people don't pay any attention to it at all. So let's get started. Tiara, what mistake should we focus on first here?
I'd say emotional decision making.
Yeah. So this is probably the most common mistake that beginners make. So that definitely makes sense to me. All right, so picture this. You subscribe to my channel to support my dream of supporting my family of 4 with YouTube. Sorry, I had to throw it in there, but I would appreciate it. Anyway, back to it here. So let's say that you've just invested in your first stock and the market takes a nosedive. You know, your heart starts racing, palms get sweaty, and all you can think about is mom's spaghetti. It's my ode to Eminem. Sorry. Like I was saying, all you can think about is selling before you lose everything. So for many beginning investors, that is reality. Emotional decision-making is a terrible thing when you're an investor. Fear can make you panic sell during market dips, while greed might push you to invest more than you can into a hot stock, right? But here's a quick tip to kind of keep your emotions in check. So create a solid investment plan before you buy your first stock. Stick to that plan no matter what, even when the market is going crazy, up, down, doesn't matter. You just follow the plan.
Let's follow the plan.
And something you should always remember with this, the overall stock market, it has its peaks and valleys, but it has literally always come back stronger than ever over a long enough timeline. So even when things get ugly, and they will, trust that it'll bounce back, because it will.
Such faith in a market designed by humans, the same species that thought fidget spinners were revolutionary.
Okay, well, excuse me, Tiara, but this statement is actually backed by data. So if you bothered to look at the graphic, you would have known that. But controlling your emotions is just the tip of the iceberg. So Tiara, what's the next biggest mistake? And don't give me some smart mark either.
That would be a lack of diversification.
Okay, so you've heard the saying, don't put all your eggs in one basket, right? Well, in the stock market, this advice is crucial. So imagine for a second that you've invested all your money into a single tech company. That sounds great, but what happens if the tech industry takes a hit, or even worse, that stock gets nailed for some type of fraud? Your entire portfolio could come crashing down, but diversification makes that much less likely. So you want a mix of different investments. You want stocks, bonds, funds, and maybe even some real estate investment trusts spread across various sectors and geographies. This way, if one sector of your portfolio is having a bad day, the others can help pick up that slack. But true diversification isn't just about buying a bunch of random stocks. It's about understanding how these investments actually work together. Now, I have to say, if you're nosy, and there's nothing wrong with it, I'm pretty nosy myself, and you want to see how I diversify my own portfolio, I actually created a video that I'll link to at the end of this video for you to check out that I think that you will definitely enjoy. Now, I know you're thinking, diversification sounds great, but how do I know, which investments to actually choose? Well, this next point that I'm going to get into here, it illustrates exactly what investments you shouldn't choose. So, Tiara?
Stay away from chasing high returns or trends.
Yeah, so how many times have you been scrolling through your social media feed and people are raving about the latest hot stock, right? 2024, it had NVIDIA. That's a great example. So chasing high returns of trends is such a common practice because you have the fear of missing out. But the truth is, by the time that you hear about a trend or stock, it's often too late anyways.
Breaking news. You're not a stock market clairvoyant. Sorry to shatter your TikTok guru fantasy.
Yeah, so sorry if you hate to hear it, but Tiara, she's dead on here. She's dead on. So you end up buying high, and oftentimes the stock will start to dip. Usually this is because you might be so focused on potential gains that you forget to look at the fundamentals of what you're actually investing in. So how do you avoid this trap? So don't just jump onto the bandwagon because everyone else is. Look at the company's financials, understand its business model, and consider how it fits into your overall investment strategy. You need to remember that investing, it isn't about finding the next big trade. It's about building a solid portfolio over time with many investments in many different industries. And speaking of doing your homework, that actually leads us perfectly into the next point here. So Tiara, what is the next point here?
Neglecting research and due diligence.
Yeah. So, all right. So imagine, let's say that you need to buy a car. Would you just walk onto a lot, point at the first shiny car that you see and say, well, I'll take it? Of course not. But that's exactly what some people do in the stock market. So neglecting research is like investing blindfolded. You might get lucky, once, twice, three times, but in the long run, you're really setting yourself up for a crash. And understanding what you're investing in really helps you make informed decisions. So is the company profitable? What's their competitive advantage? These are the things that you need to know as an investor. And research, it helps you spot red flags before they come and bite you in the butt. And due diligence, it gives you confidence in your investments so that when the market gets rocky, you'll sleep better knowing that you've done your homework and believe in your companies that you're holding for years to come. So how do you start with this? Well, begin with the basics. Read, company annual reports, check their financial statements, and just stay up to date with industry news. Now, I know it might sound boring, I get it, but trust me, it is a lot more fun doing that than watching your hard-earned money disappear because you invested in something that you really didn't understand. But here's the thing. So even with all this research, you need to go a step beyond to be a successful investor. So Tiara, what is the next mistake that people make?
Not having a long-term plan.
Absolutely. So, you've done your research, right? And you've diversified your portfolio and you're feeling pretty good about your investments. But then what? Well, without a clear long-term plan, you might find yourself making random decisions based on, short-term market fluctuations, or like I said earlier, the latest hot tip from a coworker, right? Having a long-term plan is crucial because it helps you stay focused on your goals. So whether that's, saving for retirement, buying a house, or even building generational wealth, making consistent decisions that align with your objectives rather than, reacting to every market change is the true path to success with investing. So how do you create a long-term plan? Well, you have to start by defining your financial goals. So are you investing for retirement in 30 years, or are you, saving for a down payment for a house in 5 years? Your timeline should really influence your investment strategy. So for instance, I'm looking to retire in 26 years. And when I look at random fluctuations in the stock market, it means next to nothing to me because I know that I'm in this for the long haul. Now, next, you want to consider your risk tolerance. So can you stomach the ups and downs of a more aggressive portfolio, or do you prefer a smoother ride? And finally, create a plan that aligns with these factors. So this might involve a mix of stocks, funds, bonds, and just other assets that, change over time as you get closer to your goals. But here's the thing. So even with a solid long-term plan, there's still a very big temptation that trips up many investors, both new and experienced. So you want to know what that is? Well, Tiara, can you tell us?
Overtrading or trying to time the market.
Yeah, so this is easily one of the most common mistakes that people make. And I would argue that it's one of the most damaging as well. And frankly, I've done it myself too. So all too many new traders, they're glued to their phones, watching the stock prices tick up and down. They buy when they think the market's low, and they sell when they think it's peaked. Now, in theory, this sounds like a great idea, but it's easily one of the dumbest things that you can do. And here's why. So first, it's incredibly difficult, even for professionals. You're essentially trying to predict the future, and you just can't do it. If you think you're special, you're not. And that's okay though. I'm not special either, and most people are not, so it's okay. Second, it can rack up hefty transaction costs. So each trade comes with fees, and those can add up fast, eating into your potential profits. Now, many people ignore these fees as they are usually like $10 or less per transaction, but if you try to day trade, you need to consider them for sure. And third, you'll probably miss out on long-term growth. So from my years of experience, I can tell you that the market's best days often come right after its worst days. And if you're out of the market, you'll completely miss that rebound. So what should you do instead? Well, I recommend that you consider a buy and hold strategy. So instead of trying to jump in and out of the market, invest in quality companies or index funds on a consistent basis and just hold them. Now, it's less exciting, sure, but it is often more effective. Now, index funds especially are a brutally boring investment strategy, but it's also one of the best for predictability. So if you don't believe me, I have a video that I made previously that I'll link to at the end of this video that I urge you to check out, which shows just how good returns can be by being a boring investor. And the results are kind of shocking, actually, more than you'd think. Now remember, the stock market is a tool for building wealth over time. It's not a get-rich-quick type of scheme. So if you see someone selling you a course on day trading, be extremely skeptical, as the success rate for day traders is right around 4% of people. And I'd argue that it takes a truly unique person to handle the ups and downs of the profession, because I couldn't handle that type of pressure. And I don't know if you could, but I feel like most people can't. But hey, even if you've avoided all these mistakes so far, as I mentioned in the intro, there is one critical mistake that will instantly reduce your returns, and most people don't pay any attention to it. And that is, well, actually, Tiara, what are you doing right now? Can you jump in here?
Oh, sorry. That would be investing without understanding fees and costs.
Yeah, thank you. Yeah, so especially for beginners, this is a super common issue. But I'm not talking about just the trading fees necessarily that I mentioned earlier, right? So let's break it down with an example. So imagine that you're comparing two similar investment funds. Fund A has an annual fee of 0.5%, while Fund B charges 1.5%. Well, it doesn't seem like that big of a difference, right? Well, over 30 years, that 1% difference could cost you tens of thousands of dollars in potential returns. So needless to say, that's significant, and you definitely want to pay attention to it. So here are some common fees to watch out for. So first is expense ratios for mutual funds and ETFs. That's a big one. Next is trading commissions, which I mentioned earlier, but that's a big one as well. Account maintenance fees and management fees for actively managed accounts. Now keep in mind, sometimes paying a bit more for a professional management or a specialized fund, it can be worth it depending on the return. The key here is to understand what you're paying for and why you're paying it. So how do you avoid this mistake? Well, it's simple. Always check the fees before investing. So compare similar investments to see if you're getting a good deal, and consider low-cost index funds like those from Vanguard, which is what I usually invest in, which often have the lower fees than actively managed funds. Now, I mentioned twice in this video that I had other videos that I thought that you'd enjoy. So here they are. So this one right here is where I had AI roast my investment portfolio, and this one talks about the power of boring investing. So check out whichever one you think that you'd enjoy. But before you go, please remember to subscribe to the channel to unlock financial success one AI chat at a time. Thanks for watching.